Welcome to The Explainer. Today, we're decoding a truly fascinating macroeconomic puzzle from April 2026. Asset classes that usually move in totally opposite directions are suddenly holding hands and running up the charts together. It's kind of like cats and dogs suddenly becoming best friends. We're going to uncover exactly why this is happening, what the underlying data is actually telling us, and the incredibly delicate tightrope the broader market is walking right now. To get there, here's our roadmap. We'll kick things off with the dual-theme anomaly itself, then dive into big tech's AI boom and check out corporate resilience beyond just the tech sector. After that, we'll map out this fragile market equilibrium, look at the option structure and key levels, and finally, wrap up with the macro trading plan. Let's get right into it. Starting with Part 1, the dual-theme anomaly. Okay, so if you spent any time studying market history, you know the textbook rules, right? Normally, high-growth, long-duration tech stocks love low interest rates, low inflation, and falling discount rates. On the flip side, cyclical sectors, think energy, materials, financials, they thrive on nominal growth, sticky inflation, and a higher-for-longer interest rate environment. They are practically polar opposites. And yet, right now, we're looking at this extremely rare anomaly where both are rallying simultaneously. Tech is surging on a massive AI narrative, while energy and financials are ripping higher on strong nominal growth. But to really grasp how this dual-theme market kicked off, we have to look back at how the market reacted to a pretty massive shock. Just think back to how quickly the market completely digested the huge geopolitical risk with Iran in early April. We had major threats to energy infrastructure by late April. Tanker traffic in the Strait of Hormuz dropped to single digits. I mean, the International Energy Agency literally called it the largest supply disruption in history. But get this, by April 13th, the S&P 500 had erased all of its war-related losses, and by April 24th, it hit a brand new all-time high of 7,165. The market basically shrugged off a historic geopolitical crisis, treated it as a bounded risk rather than some binary disaster, and pushed the S&P up an astonishing 10.4% for the month. That wild resilience is exactly what set the stage for this entire dual-theme anomaly. Moving right along to Part 2, Big Tech's AI boom. The data here shows us that AI is absolutely no longer just hype, and it's not just multiple expansion. This is a genuine productivity revolution backed by cold, hard cash. Look at the 2026 aggregate capital expenditures. CapEx was just raised to a staggering $693 billion. That's up 13%. And this isn't just money being thrown at a wall, it's backed by locked-in, long-term supply contracts. Google Cloud's backlog nearly doubled quarter over quarter to $462 billion. Amazon's custom silicon, if you treated that as a standalone chip company, it's hitting a $50 billion annualized run rate. And Microsoft's Copilot isn't just some trial program anymore. Paid seats just jumped from 15 million to 20 million. So what's rising right now isn't just the price-to-earnings ratio, it's the actual underlying earnings. But here's the crucial point. You have to understand how the market differentiates between these tech giants based on how they're spending that money. Back in April, Meta raised its CapEx by $10 billion, and the market absolutely punished them for it. Why? Well, because Meta can only absorb those massive infrastructure costs internally through their advertising business. The return on investment just isn't immediately visible. On the flip side, the market wildly rewarded Google and Amazon for their massive spending, and that's because they can monetize their infrastructure externally. They sell those computing resources directly to enterprise clients through their cloud services. So the takeaway? The market loves AI spending, for sure, but really only if you have a hyperscale cloud business to instantly sell it to somebody else. Section 3, Beyond Tech, Corporate Resilience. 65%. Let that number sink in for a second. That massive figure is Eli Lilly's year-over-year volume increase for treatments like Mounjaro and Zepbound. What's absolutely fascinating about this is the strategy behind it. Eli Lilly proactively cut their prices by 13%. The market had been totally worried that cheaper generic alternatives would crush their pricing power. But instead, Eli Lilly sacrificed price to gain volume, and that 65% surge proves that demand elasticity in this market is incredibly strong right now. They're demonstrating pure, high-quality growth that doesn't rely on AI hype or some perfect macroeconomic backdrop. And then we have 2028. That represents the year Caterpillar's data center power construction orders are already booked out to.
Caterpillar's stock is up 160% over the past 12 months. When people ask, hey, is this AI infrastructure spending just a short-term bubble? Well, Caterpillar's order book directly answers the question of how long this AI capex boom is visibly sustainable. Customers are literally locking in heavy power and industrial machinery orders 3 to 4 years in advance. This beautifully ties our two themes together. The high-tech AI boom is directly fueling massive growth in traditional, cyclical industrial sectors.
Which brings us to part 4. A fragile market equilibrium. We find ourselves in a very fragile equilibrium. Right now, the market believes two major things. First, that AI is raising productivity so much that it actually offsets the pain of high interest rates for these tech companies. Second, that inflation and nominal growth are strong, but crucially not out of control. That means the Fed doesn't need to cut rates urgently, but they also don't need to hike them aggressively. This creates this incredibly narrow Goldilocks zone where you can somehow buy AI chips and oil stocks on the exact same day. But here's why this matters for your portfolio right now. The narrower the equilibrium, the more fragile it becomes. If inflation surges a bit too much, or if AI growth stalls out even slightly, this whole balance tips. And the danger is that the weakest, narrative-driven beta stocks, those companies with zero real profits, relying purely on concept and hype, they are going to be the absolute first to crash. Moving to Section 5, Option Structure and Key Levels. Tracking the options market gives us some real actionable boundaries, specifically looking at gamma and delta exposure, which basically shows us where market makers have massive financial risk and need to hedge their bets, reveals some very clear battle lines. With the spot price sitting right around 72.20, there is a massive structural upside ceiling at 7,300. This isn't just some psychological number, it is a literal wall of call resistance where dealers are highly likely to start selling. On the downside, we've got a new, higher short-term defensive support level at 7,100. This tells us the market is incredibly well supported on dips right now, but it's really going to struggle to break out massively to the upside without a serious, sustained catalyst. Drilling down just a bit more, the crucial underlying metric here is the high volatility line, or HVL, which is sitting at 70.70. Because the index is trading well above this 70.70 level, we're in what's called a positive gamma stability zone. In plain English, it means that as long as the market stays above 70.70, market makers and dealers are probably going to suppress volatility. They'll mechanically sell the rallies and buy the dips just to balance their books, which keeps the broader market relatively calm and range-bound.
Finally, Section 6, Trading Plan and Macro. Looking ahead, these are the absolute critical macro events you need to have on your radar. The Treasury's Q2 financing estimate and the Senior Loan Officer survey on May 4th will tell us if banks are actually loosening credit. But the vital markers are the ISM Services price component on May 5th and the non-farm payrolls on May 6th. We already know manufacturing prices hit their highest levels since 2022. If services inflation proves to be sticky too, the 10-year yield is definitely going to spike. And of course, that jobs report will dictate whether this higher-for-longer rate narrative stays intact or if cracks in the labor market finally force the Fed's hand. Plus, we've got major AI tail risk earnings coming up from Palantir, AMD, and ARM that are going to fiercely test the whole semiconductor narrative. So how do we navigate this? The core strategy from our analysis boils down to this: stay in AI, but reduce leverage. Keep high-quality alpha and sell weak beta. And increase your quality growth exposure to hedge your AI risk. Honestly, this is not the time to be reckless. The clear takeaway is to avoid adding leverage at the tail end of a market squeeze. You definitely want to stay exposed to the massive tailwinds of AI, but you absolutely must shift away from those fragile thematic small-cap stocks that are just running on hope. Aggressively rotate toward high-quality names with real, actual cash flows, like Microsoft, Amazon, and Eli Lilly, to actively hedge your risks. With corporate earnings absolutely roaring, fueled by real AI capital expenditure and incredibly strong industrial backlogs, but global consumption cooling at the margins and sticky inflation keeping borrowing costs high, it leaves us with one massive question. How long can this fragile, incredible dual-theme tightrope act actually continue before one side of the scale finally tips? Thank you so much for joining me for this explainer. Keep your eyes on those macro data points, stay nimble, and I'll catch you next time as we continue to decode the markets.